Did you know Australia's tax-free threshold jumped from 6,000 to 18,200 in FY 2013 and has remained the same ever since? It's remarkable that it has stayed at this level despite almost 47% cumulative inflation over the same period. No wonder so many people aim to reduce their taxable income to this long-standing tax-free threshold whenever they have strategies available, mistakenly thinking it's the most effective way to achieve zero tax. I'm here to tell you that not only is 18,200 not the real tax-free threshold, but even the effective tax-free threshold is not always the best place to stop reducing your taxable income. In this video, I'll show you why using two real-life examples. Understanding both can save you thousands of dollars and help you make much smarter tax decisions. Let's dive in. First, if 18,200 isn't the effective tax-free threshold, what is it? Enter 21,000. Zero tax. 22,000. Zero tax. 22,867. A little bit of tax. 22,866. Zero tax. We found the magic number. The real reason for this is a low income tax offset. The maximum offset is $700. As you can see, at this level of income, it's almost fully utilized and effectively reduces all tax on income, leaving no tax payable. If this tax offset sounds unfamiliar, don't worry. You don't need to do anything to claim it except lodge your tax return. The ATO works out the offset after you lodge. So 22,866 is a magic number, unless you are also eligible for the seniors and pensioners tax offset, which is closely linked to age and income limits. I won't get into the details of that in this video as it primarily affects older Australians. Comment down below if you want me to make a dedicated video on it. So yeah, for most taxpayers, $22,866 is the effective tax-free threshold for FY27. Meet John, a uni student juggling studies and a part-time job. Dennis retired 10 years ago. To get ahead of the CGT changes from 1st of July 2027, he sold the investment property he had owned for 20 years during FY27. Both share one common goal: to minimize their tax. Fortunately, they both have tax planning strategies that could reduce their taxable income to the effective tax-free threshold. But as you will soon see, that's the optimal strategy for one of them, but not the other. Before we get into the details, keep in mind this video is for educational purposes only, not financial advice. Your situation might be different than the examples, so it's crucial to thoroughly research or consult a professional before applying these concepts. You see, the old John, who still believes the tax-free threshold is 18,200, might think he needs to find $5,800 worth of deductions to pay zero tax. Good luck with that if you're a uni student. He might be even tempted to buy things that he doesn't really need just because it's tax deductible. Guilty as charged, I have done it too. Well, now he only needs to find $1,134 worth of deductions. Surprisingly, most of it is already taken care of. Enter the brand new tax rule from FY27, the 1,000 instant tax deduction. It allows eligible workers to claim a $1,000 standard deduction for work-related expenses with no receipts, no logbooks, and no need to keep track of individual expenses. For someone like John, earning just $24,000 a year, being able to claim a $1,000 work-related deduction without all the paperwork is a pretty good deal. On top of that, John can still claim other eligible deductions such as charitable donations, union fees, and memberships to trade, business, or professional associations. Just another $134 in these deductions is all he needs to reach the effective tax-free threshold and pay zero personal income tax. Unlike John, Dennis has a very different problem. He sold the investment property, making a capital gain of $386,400. Since the property was sold in FY27 before 1st of July 2027, the current capital gains tax rules still apply. That means he is entitled to the 50% capital gains tax discount because he owned the property for more than 12 months. As a result, his taxable capital gain is $193,200. Without any tax planning, Dennis would pay $56,674 in income tax and Medicare levy. Naturally, he wants to reduce that tax bill as much as possible. Fortunately, Dennis satisfies all the conditions to use the carry-forward concessional contribution rules. His total super balance on 30th of June 2026 was below $500,000. And he hasn't made any concessional contributions to his super over the past 5 financial years. So, under the carry-forward rule, in FY27, the maximum he can contribute to his super and claim a tax deduction for is $175,000. That's 6 years worth of concessional contribution caps, 5 years of unused caps, plus the current year's cap. Now comes the interesting question. How much of that $175,000 should Dennis actually use? Should he reduce his taxable income all the way to the headline tax-free threshold of $18,200? Or to the effective tax-free threshold of $22,866? Or should he stop somewhere else entirely? Comment A, B, or C before I review the answer. At first glance, reducing his taxable income to either of the tax-free thresholds sounds like the obvious answer. After all, paying zero personal income tax is pretty hard to beat. But here is what many people overlook. Concessional contributions are generally taxed at 15% inside your super fund when they are received. A concessional contribution only makes sense if the personal income tax you are avoiding is higher than the contribution tax you are paying inside super. That's why reducing your taxable income as much as possible shouldn't be the goal. Instead, we should focus on the net tax benefit of each concessional contribution, which is personal tax avoided minus contribution tax paid. Now let me show you the real game changer. This table does all the hard work for you. The last column shows the net tax benefit of making $1 more of concessional contribution at each income level. You'll notice it has more income bands than the tax table you are used to seeing. That's because it doesn't just take into account your personal income tax rate. It also factors in the Medicare levy and the gradual withdrawal of the low income tax offset. I know it looks a little technical at first, but stick with me. Once you understand it, you will have a simple shortcut for deciding how much of your concessional contribution cap to use without having to do any of the calculations yourself. Let's work through it together. Below the effective tax-free threshold of $22,866, making additional concessional contributions provides no or even negative tax benefit. Between $22,867 and $37,500, your effective marginal tax rate, including the Medicare levy, is 17%. After paying 15% contribution tax inside super, your net tax saving is only 2%. Between $37,501 and $45,000, your effective marginal tax rate increases to 22%. After allowing for the 15% contribution tax, you are still ahead by 7%. Between $45,001 and $66,667, the net benefit increases to 18.5%. You get the idea. As you can see from the table, the net benefit isn't constant. It changes depending on both your effective marginal tax rate and the contribution tax you pay. Now let's apply this to Dennis. Although Dennis has enough carry-forward concessional contribution cap to reduce his taxable income all the way to $18,200, that doesn't mean he should. In fact, once his taxable income falls below the effective tax-free threshold of $22,866, every additional dollar of concessional contribution no longer reduces his personal income tax. Instead, it simply attracts the 15% contribution tax inside super, leaving him worse off overall. Even above the effective tax-free threshold, the benefits quickly diminish. Between $22,867 and $37,500, every additional dollar of concessional contribution improves his overall tax position by just 2 cents. Between $37,501 and $45,000, the benefit increases to only 7 cents per dollar. By contrast, at higher effective tax bands, each additional dollar of concessional contribution delivers a much greater net tax benefit. So, how much of the $175,000 carry-forward concessional contribution cap should Dennis actually use? There is no single right answer. How far he reduces taxable income this year depends on his expected taxable income in future years. If he expects to be in a higher tax bracket again, preserving some of his unused concessional contribution cap could deliver a much greater tax benefit later on. In other words, the ultimate stopping point isn't determined by a tax-free threshold. It's determined by where each additional dollar of concessional contribution delivers the greatest net tax benefit, both today and in the future. If you find this video useful, please give it a like and subscribe. For more practical Australian tax and super strategies, check out my tax and super playlist. Thanks for watching. I'll see you in another one.